Hey guys, in this video, I'm sharing step by step how my client AJ went from struggling with inconsistent returns to making 100K in just 96 days with my options trading system inside my Millionaire Mentorship program, which, by the way, you can learn more about by booking a call using the first link in the description down below. So, here is a screenshot of AJ's actual results. He sent me an email slightly after the new year to just kind of share with me how he was doing. As you can see, he finished the year beating all of the major market indexes after implementing my strategies. And that's not all. He also invested and had the confidence to start trading money that was inside of his business. And he was able to make another 10K in just 1.5 months of trading. So he is now trading 2 accounts with a lot of success. And I would love to walk you through how he did it. So AJ did all of this without spending more than 2 hours per week looking at charts. In fact, we don't really look at charts much at all in this program. Okay. Now that sounds wild to some people that are going to be like, how do you trade options without charts? There's just a way to do it where you look at them very rarely. And that's what I do. He didn't take on excessive risk that kept him up at night. And he wasn't chasing high flying stocks that eventually crash. Okay. That last thing might have been something he was previously doing wrong. Okay. I'm not really sure. I can't remember what he was ineffective at before, but I can tell you the things that he shared with me that changed what his outcome. Okay. So previously, AJ had been trading very in a limited way with options because he knew he didn't really know exactly the right moves to make. And so he sought out mentorship, which was very wise on his behalf, as you can see. And he was able to get some very good habits and strategies in place. And that is how he came up with this result. Okay, this video could change your life. Options trading changed my life. So from this point forward, if you're serious about getting better at options trading, I really recommend that you put away all distractions and pay attention to what I'm about to share with you, okay? So the truth that no one will tell you is that you absolutely can generate consistent income with options trading without spending countless hours analyzing charts or taking on excessive risk. Most traders aren't capable of doing this because they simply don't understand how to properly select quality stocks, efficiently use low risk strategies, and manage their risk effectively. It's really as simple as that, okay? But don't worry, after watching this video, you won't ever have that problem again because I'm going to walk you through how you can avoid some of the pitfalls and have success like AJ has had. So first, I'm going to tell you a little bit about my journey and how this all happened. 8 years ago, I was trading different strategies, sometimes winning, sometimes losing, and I really didn't like losing. So I never was achieving sort of the consistent results that I knew were possible because other mentors that I had come across were sort of having those sorts of results, and I really wanted them. So to give you an idea of where I was at, I might make 1K 1 month, then 6K, then 2K, then 10K, then 3K. And I wanted some consistency. So I spent thousands of hours studying the markets, testing different approaches, taking different courses. I even flew far and wide to take these courses. One of them was in Hawaii. That was awesome. And eventually, what I did was I developed a system from the best strategies that I learned through doing all of that research and all of those courses that allowed me to get 105% return in just 1 year. I had that in a bull market, I will say that, and I had over 100% returns 2 years in a row in both 2023 and 2024. Okay. So now I make between 30 to 60K per month options trading with a portfolio of less than $600,000. I do options trading I have other funds that I do options trade with, but typically when I'm talking about my results, I'm talking about 2 brokerage accounts that I manage completely on my own. That is my brokerage money, not my retirement money, which I talk about in a different way on different videos. But last year alone, on that 600K account, I made 400K trading stock options. Okay. Then something interesting happened. A bunch of my friends, I got friends in all sorts of places, doctors, entrepreneurs, even some lawyers started asking me about it because they had seen a shift in my life that I wasn't working so much on another business that I own. And they saw that I was really digging into these stocks. So they're like, how's that going? Because there's a lot of people that assume there's a lot of risk there. And I would say it's going fantastic. I love it. I can't believe that it's going as well as it is. This has been game changer for me. So they wanted to know more. They're a little skeptical. So I started teaching them my strategies and they started having success as well. At the time at the same time, I sort of went and started a Twitter account, now X account, and wanted to learn more from the community there. What I learned from being on X is that I actually was better at trading than most of the people there. And I had a lot of unique strategies that they had not been introduced to. A lot of people there were simply talking about the covered call and the cash secured put. And there were a lot of famous accounts that were specifically talking about those two strategies, and they weren't leveling up from there. So anyway, people wanted to learn how I was getting such amazing results with options trading. And so I decided to create the Millionaire Mentorship Program to teach options traders who were struggling to get consistent results. After I was at X for like maybe 4 or 5 months, I was like, you know what I'm going to do? I'm going to book one-on-one calls with people and they can pay me per hour to teach them a strategy here or there. What ended up happening was that I didn't feel like I was giving people the tools that they needed during 1-hour sessions. To really make them into successful traders. I knew that they needed sort of more long-term guidance, probably like at least an 8 to 12-week program, and then probably need to stay in a program even longer. And I do think it takes some time to learn options. I think 1 year is the minimum, and 2 to 3 years is probably best. Okay. To stay with someone and learn all of their strategies. So that's why I came up with the Millionaire Mentorship Program, and I stopped doing hourly consulting because I didn't think it was in their best interest to do so. I think that everybody needs a really real robust education in this, and that's what this program offers. So most of the people that started the program too, I made sure I vetted them to make sure their portfolio sizes were large enough to benefit from my system. So I don't tend to work with traders who have sort of like a 5 to 10K account. 30 to 50K is the minimum. I prefer accounts that are 75K plus. Okay. I just feel like these strategies work better with that because we are trading the best stocks on the market, and the best stocks on the market are usually expensive. Okay. And that's really the crux of why. So with this in mind, when I was working with these clients that did have 50K portfolios and above, and most of them were in the 100, 250 to 500K range, we were easily able to get these clients into a situation where they were making a consistent 5K a month from their portfolio with my options trading system. And that's how I met AJ. He found me on Twitter, and when we first met, I knew that he had one main struggle, and that was getting consistent returns with options trading without taking on excessive risks or spending many hours a week trading. And so that's how we started when he joined with the options system I'm about to reveal to you. So my options trading system for making a consistent 5-figure per month income without spending hours a week on charts or taking big risk really boils down to 4 things. The first is stock selection. Your trading results are only going to be as good as your stock selection. That doesn't mean that you can't screw up and make a bad stock pick here or there, but they have to be good most of the time. That's just the reality. Number 2 is that you have to master covered call variations. And you can go on to more advanced trades later, but until you master the covered call and understanding how call options exist in your portfolio, you're never really going to master the other option strategies that you could learn because they're all based on that basic trade. 3 is proper position management. And number 4 is graduating onto the advanced trades. And the crazy point about our AJ's results is that he hasn't even gotten to the advanced trades yet. All of his results were just on some of the basic trades with the covered call and the cash secured put. I often ask him from time to time, I check in and say, hey, are you taking advantage of some of these advanced trades yet? And he says no. And I'm just sort of like, when are you going to do that? There's better results you could even have from here. So what's exciting for AJ is it only gets better. But the number one thing, okay, so where we're starting is with stock selection. I think you guys, if you've watched my YouTube videos before, this you may have heard this a few times, but we're going to do it again in case this is your first time here, okay? So if you are struggling with inconsistent results from options trading, 99% of the time, it's because you're trading stocks that perform inconsistently, okay? And, this was sort of the case with AJ and other people like him. They didn't know how to make a great stock pick for options trading. So think about it. If you're trading stocks that have high volatility, your options trading results will also have high volatility. And so your results will be like a roller coaster. It's a really simple thing to grasp, I think, once I explain it that way, right? Okay, so what I did was I compiled a stock selection checklist for my client base and created the perfect balance between risk mitigation and growth potential. So I don't give anyone stock picks. That's not even legal for me to do so, and I don't want to. But what I do give people is the tools to be able to make great stock picks themselves. And that is far more profitable more powerful is what I want to say, and profitable. Because you should have an education. You want to have an education that follows you around that you can take with you and know how to evaluate a stock as soon as you see it. Then if you're at a barbecue and your friend tells you, oh, this stock is so amazing, go check it out. You can go, you could go look and evaluate it yourself versus taking their or my word for it. Like you want to have the information and know how to evaluate that for yourself. So the first thing that I do here is that when my friend mentions a stock at a barbecue is that I go open up Yahoo Finance. It's a free website. And I look at the charts and I see and I go and I look and I say, hey, are the 5-year, 1-year, and 3-month charts for this stock all up? Currently, we are in sort of a market that was very bullish that's turning bearish. We're in 2025 in the spring, and we've had this tariff conversation going on. And so a lot of the winner stocks don't have a rising 3-month chart right now. So I'm really looking at the 5-year and the 1-year. But guys, here's this thing. When those 3-month charts are down, I don't buy the stock. Okay. So everyone's just like everything. If you're watching this, you're wondering like, well, what do you do when it's a great stock and the 5-year and the 1-year up, but the whole market's in a downtrend, so the 3-month is down? The answer to that is I don't buy shares in that company until it starts turning around, okay? But why this matters, when I look at a stock's 5-year, 1-year, and 3-month charts, I'm confirming that the stock has a consistent uptrend across multiple time frames. This is about ensuring that we're trading with the trend and not against it. So there's a term in stock trading and they say, let the trend be your friend. And that's exactly what I'm doing here. The trend has to be my friend. You don't want to paddle upstream. It's a waste of energy and, more importantly, a waste of your money. Most people that are making mistakes trade stocks that look cheap after falling, hoping they'll bounce back. And what they don't realize is that falling stocks often keep falling and rising stocks often keep rising. And so that simple chart check that I do eliminates like a lot of the pain that traders are going through. Okay. So when I take a trader like AJ and we just get rid of some of the junk stocks that are in their portfolio, that eliminates about 80% of their problems they're having right there. Okay. So how to implement this? Again, you go to Yahoo Finance, you enter your ticker into the search bar, you look at the charts and you just go to 5-year, 1-year, and three months. And if all three aren't trending upward, then you're probably not buying shares right now. If the 5-year and 1-year are down, just move on. That's not worth it. Even in a down, like if we're in a downtrend right now, which we are, if the 3-month is not there, that's not as concerning to me. Okay. But if the 5-year and the 1-year are, I just move on. Like, forget it. There are greener pastures and everywhere else. There's so many better stocks out there. Don't waste your time. This takes less than 30 seconds per stocks, but saves you hundreds of thousands in potential losses. Just saying, it does. Okay. The second thing that is a part of how we make our traders into successful traders is and make successful stock picks is we make sure that the revenues are rising 4 years in a row. So why this matters, companies with consistently increasing earnings and revenue for 4 consecutive years demonstrate they know how to make money. Okay. And really, the only thing that Wall Street wants to see from these companies is that they can make money and they can get better at making money. So when their money goes up that they're bringing in every year, they're saying to me, hey, we know how to make money and we get better at making money every year. Well, that's what we want, right? So this isn't just about current profitability. It's about a proven business execution over time. Okay. Most traders look at stocks and that their friends will recommend or stuff that's trending on social media because they're like, oh, this company is going to have a great future. Okay, that's a different thing. Speculatively, if you really believe in that company, throw a couple $100 in there, buy some shares. Hopefully they take you to the moon, right? But that's not what we're doing with options trading. For options trading, that's a terrible idea. What we need to do is we need to pick stocks that have rising profitability and rising revenues. Otherwise, we are just making ourselves ripe for losses, which is not something that we want. So how do you implement looking for this? You go to Yahoo Finance, you click in that ticker on the left-hand side. There is a financials little word there. You click on that, and then it will open up the profit statements and the income statements for the last 4 years. And you just go across each line. You look at the total revenue. It'll say it from 21, 22, 23, 24. And you make sure those numbers are all going up. Okay. And then you look at the gross profit 4 years in a row and you make sure those numbers are all going up. If they're all going up, woohoo, it's green. It gets a pass. If one of them is down, move on. No, we're done. We're done. Okay. That's done. Strike 2, you're out. Or even strike 1, you're out there. Okay. The third thing is that we want 70% institutional ownership in these shares. Why does that matter? When institutions own at least 70% of a stock, it means the smartest money managers with the most resources have done extensive research on that company and have decided that that company is worth investing in and staying in. Okay. The reason why that stock is up consistently 5 years and 1 year in a row, I realize that some of them are down on the 3-month right now, is because though the institutions like college endowments, insurance companies, banks, etc., have put money into these companies and then to buy shares, that's how they put money in. And then over time, they have continued to add to their share ownership because the company still looks good and they think that's a good place for them to put their money. It's really as simple as that. They also tend to create more stability in the stock price, which will create more stability in our options income. See how beautiful that is? So most traders have never considered who else is buying the stock that they trade options on. If it's a bunch of retail traders, it's a rough road and it's a rough ride, believe me, because retail traders just don't trade in the same way that institutional traders do. Institutional traders do things in a far more predictable way, and that's what we want to get predictable results, okay? So the reality is that institutions determine stock prices, and it's obvious that we should align ourselves with these powerful people and these powerful market forces rather than fight against them. Like, again, we don't want to paddle up a river. Okay, so how do we implement this on Yahoo Finance? You just go to the Holders tab. You check the percentage of institutional ownership. And if it's below 70%, just be very cautious about proceeding. That's the way that I would do that. The last thing that I look for in a stock pick is that that company is a market leader. Why this matters is that companies that dominate their industries or have monopoly-like positions have pricing power, customer loyalty, and barriers to entry for other businesses that are going to compete with them. They can compete better on price. They can compete better on so many things that a lot of other, rising star companies don't even want to come up in that space. They would rather try to come up in a different business that's new than compete with something that's already has a legendary player within it. This translates to more predictable stock performance, which is exactly what we need for consistent options income. It's common to trade on the third or fourth best company in with some of these traders that are failing or are just not getting the results that they want. So a company, gosh, you guys, I sort of hate to dog on SoFi, but I also have to dog on SoFi right now. So I will use it as an example. There are a lot of retail traders that are just such big fans of SoFi. And the reason why they say is because it has a new business model, which is it's mainly online. It's an online bank. And for some reason, they say that this is a new business model. It's not a new business model. There's nothing new about it. Every big bank has an online business model. It's just that SoFi doesn't have any locations. That's not a benefit. That's a disadvantage. I don't understand this stock pick. And when you look at SoFi's charts, it's very the caution that I am throwing out there, you see that in stock price. It can't stay up. It doesn't want to stay up. It doesn't want to go higher. Who are they fighting against? JP Morgan Chase. Do you have any idea how huge JP Morgan Chase is, or a Wells Fargo or an Amex or something like that as a company? I'm just saying. SoFi doesn't even come near to the power that those companies have. And they have far more resources. And believe me, there are times when you want to go into a bank versus just be on your phone or like chatting on a chatbot. It's not the new business model that many people think that it is. So the reason that these retail traders like SoFi, you guys, let's just boil it down, is that it's cheap. It's a cheap stock to buy. So they feel like they're ballers when they can execute 15 contracts on SoFi instead of one on JP Morgan Chase. Guess which one's going to win more often? JP Morgan Chase. It's just a fact. Okay. So market leaders, how are we going to look for market leaders? This is just something that you have to do mentally. You have to go, hey, is this company the clear leader in this industry? Do they have unique advantages that competitors can't easily copy? And are their profit margins above their competitors? Okay. So you can kind of look that one up on Yahoo Finance. But other than that, it's just going to be really asking yourselves, who are the monopolies? Who are they? Apple and Amazon come to mind when I think of that. When I go, monopoly, Google is in court right now and has been determined to be a monopoly, okay? So you could also look at who's in lawsuits because they are a monopoly. That's an interesting search tool. So AJ's income became more consistent both from increasing the dividends he was getting from holding blue chip stocks and from the premiums he was generating from the covered calls and cash secured puts. Okay, so now's the time to show him how we could put fuel on the fire to take his baseline income generation to the next level. All right, so he needed to master covered call variations. Okay, so a lot of people just do, they learn the covered call and they're just like, people will even say to me, why would I take your course on learning the covered call? I can just learn it for free on YouTube. I'm like, I know, I've seen those videos on YouTube. And the thing is they don't teach you any variations on it. They say, sell a 20 delta. And then everyone like sheep follows that advice, even though why? Is anyone figuring out why they want you to sell a 20 delta? No one asked. They just said somebody who knows what they're doing said that. So that's what I'm going to do. But that's not what I'm going to do. What I'm going to do is give you the power to understand what the covered call variations are and why they exist and how you can take advantage of them. So most options traders know how to trade covered calls in the traditional way, which is picking the 20 delta. But there are three main challenges with this traditional method. One is that the premiums are low. Another thing is that you can still get assigned. Like you can still get assigned at a 20 delta if that's what you're trying to avoid. And let me tell you, it doesn't work. There's a better strategy for not getting assigned. And then the other thing is that they're just not doing proper risk management. And the risk management is really coming in the stock picks. So if you're just like, I'm cool selling covered calls at a 20 delta, that's a good idea. That's not all that goes into it. That's not all that's not the whole picture. So if you want to maximize your covered call premiums without additional risk, you need to master these 4 covered call variations that I'm about to share with you that allow you to profit when the market is heading in different directions. And that's really where this comes in, right? The reason that we need the different covered call variations is because we need covered call variations to match the market that we are in or the result that we want. Okay. So I taught AJ how to rotate between 4 powerful variations. One is the fast money trade. The second one is the volatility trade. Third is the get paid to going up strategy. And the fourth is the earnings trade. I think, a lot of my traders were just originally coming in and just going like, I want to sell this based on delta, and I want a 10 to 20 or 30 delta. I've got a student every week who asks that question. What delta should you be selling? I'm like, we're not even going to look at delta, guys. We need to think about what do we want to get out of this trade? How much premium and how much cap gains and how much risk do we want to take on? That's how we're going to evaluate the covered call, not delta. Okay, so the fast money trade, what it is that it's my go-to strategy when I want to generate significant cash flow quickly while still maintaining the possibility of making some capital gains. Why it works? Most covered call traders make the critical mistake of selling calls that are too far out of the money. They're so afraid of having their shares called away that they accept tiny premiums. And this is just simply leaving money on the table. So how I implement the fast money trade is I select a quality stock from that 4-point checklist I gave you. It says 5 here, but it's really 4. 2, instead of focusing on delta, I focus on the optimal balance between premium and potential cap gains that I want to make. The third thing is I sell calls that are slightly out of money. I mean, slightly. 30 to 45 delta. Like I could even do a delta 50 here, guys. What? Okay. And number 4, I choose expirations between the 14 and 30 day out so that I can create enough theta and time decay in the contract. And then the 5th thing is that I'm really comfortable with the possibility of assignment. I actually want to be assigned. I want my shares to get called for me because then that's cash that comes back into my account that I can do another fast money trade with. So that's exactly what I want. So you have to remember here, you're still making money if the shares get called for you. It's called stock trading for a reason. We're trading stocks for money. Okay. Like if you have your shares called from you, that's trading them. They're trading them. Okay. If it's called investing for a different reason. Investing is you're keeping them. So if you're an options trader, the shares should come and go. That's exactly what they should do. If you're an investor, the shares should stay with you in quality companies. That's a very distinct difference between investing and options trading. Don't take your investments and options trade them. Then you won't be worried if your shares get called from you. So when I love to use this and when the best time to use it is when implied volatility is high and when you want to quickly capture cash flow. And also, again, when you don't mind those shares being called away from you. So don't do it when you don't want your shares called, okay? And if you don't want your shares called, don't ever do a covered call to begin with. Okay, number 2, the volatility trade. What it is, the volatility trade is about strategically buying quality stocks during market dips and then selling covered calls once the price recovers. So we're buying, we see a dip in Amazon, like, oh my gosh, you guys, last week there was a dip in Amazon to 170. The high for Amazon has been like 220, 230, something like that. A dip to 170. What do? I bought shares 170. What do? I wait for it to pop to 185 and then I sell a covered call there. Yeah, I have to be patient. I do have to be patient. That's true. But the reason why this works is because I can collect a really big premium when it gets to 185. And maybe I get to keep my shares then. Maybe I don't. I don't really care. But imagine if I do get them called at 185, what happens? Do I have a massive cap gain there of $15 per share, another $1,500? Yes, I do. That's pretty awesome. Okay, so the one thing that I want to call out here is that the mistake that the traders are mostly making out there is that most traders panic during market dips and they either sell for a loss on their shares or they freeze up and then they're too scared to buy. Okay, the volatility trade turns these dips into massive opportunities by allowing you to profit twice, once from the stock recovery and the other from the options premium. So I think it was like 2 or 3 years into my trading journey where I actually started to look forward to dips. For the first 2 years, I hated it. It was like, oh, I only want the stock market to go up. Then I discovered this trade. Then I like dips. All right. So how you implement this? You need to maintain a stock watch list of quality stocks from the 5-point checklist or 4-point checklist. Okay. Checkpoint number 5, just so you guys know, and why it says 5 here, is that the stock pays a dividend. So if a stock pays a dividend, it hits another metric that I like for stock ownership and for options trading. It's not like a take it or leave it kind of thing, like the 5-year chart and the 5-year, 1-year, and 3-month charts, or the consistent profitability. Like those are non-negotiables. The dividend is a negotiable, okay? But if it does have a dividend, it might be a really great thing to keep your stuff consistent because stocks that have a dividend stay more consistent on price, okay? So again, how to implement this volatility trade, let's start over because I got sidetracked there, is you need to maintain a watch list of quality stocks from the 5-point checklist. When the market dips, buy shares of those quality stocks on a discount, okay? Be patient, wait for the stock to recover. You could be waiting in this market. Some of these stocks are swinging like $15 a day, $10 a day. You might be waiting 2 days. It's kind of a more interesting time to do this than it was in 2023 and 2024 because to get a $10 move on stocks back then, I mean, a lot of times you were waiting a couple weeks. So this is kind of a really interesting environment for this trade, and I really like it for this time period. So you have to be patient and you have to wait for the stock to recover. And that's why stock selection is so important, okay? Because you don't really want to look at like stocks continuing to decline or get hit with major bad news. And monopolies usually don't, guys. That's the other thing. Monopolies don't get hit with bad news because a lot of monopolies, the reason why they're a monopoly is because they are taking over, like they're not in one sector of an industry. They spill over into so many different sectors where it becomes impossible to compete with them. And that's what a monopoly is, okay? So if you have bad news that comes up in a sector in an industry and you're a monopoly, that's only hitting one of your revenue streams when you have like 15 revenue streams. So bad news coming in about that doesn't really affect you in the same way that it does with a tiny company that is only in that industry or sector that's just getting blown up at that moment. So that's another reason I like monopolies. Okay. Once the stock rebounds, getting back to this trade, so we're waiting for the stock to recover. And once the stock rebounds, you sell a covered call at or slightly above your purchase price. Okay. So you can sell it, guys, look at the premium of doing that. It's insane. You can sell it above your purchase price, but if you sold it below your purchase price, holy strumpoli, that premium is going to be really huge. If you sell it above your purchase price, if you get called away, you're going to have a massive cap gain. I love this trade. And then you're collecting both the stock appreciation and the premium options premium from this trade. So do you guys get this? Do you following me? All right, I hope so. So this strategy only works really when the stock is pulling back or when individuals' quality stocks can be temporarily oversold. Okay, it requires patience and confidence in your stock selection, but the payoff is really substantial on this one. All right, the third strategy that we have is the getting paid to go up strategy. This is like when people talk about the 20 delta strategy. There's a time and a place for it. I'm not going to say don't ever do this. Like, this is actually the main strategy that I use in my 401k because I do want stock appreciation and I'm very patient there. And I also want premium. and I want the premium to act more like an extra dividend payment to me, okay? So that's the kind of result this gives you. It's better than a dividend payment for sure, but it's similar to that. So this strategy allows for you to maintain ownership of quality stocks with long-term appreciation in the stock shares while generating consistent income through covered calls. So, why it works is that many investors face dilemma. They want to hold quality stocks for long-term growth, but they also want current income. And this strategy solves that problem by selling far out of the money calls that have a low probability of assignment. Um, Pro tip here, uh, sell these on up days in the stock, never on down days. Okay. So how you implement this is you identify stocks in your portfolio that you want to hold long term. You sell covered calls that are far out of the money, typically the 10 or 20 delta. You choose longer expiration dates on this one. So you could go like 30 to 60 days. Also, you guys, if it's a really, really quality stock and it's one of the best stocks on the market, don't sell these in November and December. Your shares will get called for me for sure because those stocks rip in November and December. Okay, number 4, be prepared to roll the calls up and out if the stock rises significantly and reinvest the premiums to compound your returns over time. So I love this. So this is what I do. When I'm selling covered calls on Amazon, I'll sell a 20 delta or something like that on an Amazon cover call. I take that money and I just reinvest that right back into Amazon shares. So Amazon is paying me money to get more Amazon shares for me. I love it. I think it's going to work out really well for me in the next 10 years. It's already working out great in the last 5, so I don't see why that would continue. So this strategy works best on stocks that you want to hold for the long term during periods of gradual upward movement and when you want to generate consistent income, smaller income for sure, but you don't want to risk assignment. Okay. So you are always risking assignment, but the risk here is lower, especially if you're only selling these on up days. Don't like the worst idea would be, remember how we just looked at buying shares on the other strategy, on the volatility thing? We don't want to sell a cover call if we want to keep these shares when Amazon dips to the 170. No, we want to sell it when it gets up to the 185 and it's trading in that range, and then we sell a 200 strike. Okay, so patience is the name of the game here. Have you guys noticed this trend in what I'm doing? Don't be tempted to overtrade. Don't overtrade. There's no rush. These smaller wins here and there compound up to be big money over your lifetime, because what's happening is that you're not creating losses. Okay? Losses are really bad because losses cannot compound over time. Smaller wins can compound over time. So take the smaller wins and become really good at winning. And that really ends up into making a huge result later down the line. Okay, and then the fourth one, this one has to be my favorite, is the earnings trade. And the earnings trade takes advantage of the spike in implied volatility that occurs before a company announces earnings, allowing you to collect inflated premiums. So just do this exercise for me. I love it. Go look. We're coming up, you guys, on Amazon earnings and Apple earnings. Today is April 17th. So go look at the options premiums on Monday. Okay. And look at like the 1 week call and see what those are for that's just out of the money. And then come back earnings week. Look up when Amazon earnings is. I don't know that data is officially released yet, but it's going to be somewhere between like April 27th and May 2nd or something like that. So, and then go look at the options premium the day of earnings. It'll be massive for the 1 week. Okay. So what I do is I am selling a covered call the day of earnings before market close. And I don't care if those shares get called for me or not. I make sure that I'm selling for a strike price that is above my purchase price always on this, because you don't want to take a capital loss. No. Okay, so be careful of that part of this trade. But if the stock rockets off, awesome. I'm going to get some cap gains. And I got a really inflated premium for selling that 1 week call. And I'm happy. If the stock dumps afterwards, think of how happy I am. It's insanely happy because I just took in a huge premium and I'm not getting my shares called for me. And the next day, I could just roll out and make another big premium. It's pretty rad. I do love this trade. And so, like, this trade is the thing where people say don't trade earnings because it's gambling. And I say, what if I'm happy with the result either way? That's not gambling. That's just smart. Okay. So again, let's go through how do we implement this. The number one thing is that we identify the stock. It's still got to be a quality stock, guys, always. We sell covered calls 1 to 2 days before the earnings announcement. Honestly, if you can do this like 2 hours before market close, the premiums are highest then. Choose strike prices based on your comfort level. So, further out of the money is safer if you don't want to get called, but it also collects less premium, but the premium will still be high. After earnings, when the IB crush occurs, I mean, this is as simple as you're just going to go to bed that night. And when you wake up in the morning, half of the value from that contract is going to be gone instantly because all the implied volatility in that contract is now gone. It doesn't exist anymore. The event that was causing the implied volatility is it's finished. Okay. So oftentimes you can buy the call back or roll it out for pennies on the dollar. It's amazing. And the fifth thing is in this contract, if the stock moves against you, you could roll it out if you want to, because a lot of times these earnings spikes, they only last like a few days afterwards. You'll have to look at your stock that you're trading and see what the trend is, because oftentimes stocks have a post-earnings trend. It's another secret that I teach on my course. So, but see if you can identify a pattern there before you roll out, if you want to roll out, or you just get assigned and you just like, that's fine. That I knew that would happen, and that was part of the plan. So, of course, like the only time this trade is going to work is right around earnings. The other thing that I want to give you guys a tip here on is that for earnings, the premiums on a stock rise like in this interesting way 3 weeks before earnings. So they start to go up 3 weeks before earnings, 2 weeks before earnings. They get more inflated. The last week, they're super high. The last day, they're sky high. So keep an eye on that. I even keep a lot of my shares free and clear, and I'm cognizant of when the next earnings will be so that I can have lots of 100 shares of stock to specifically do this trade. So one of the things that I talk about in the mentorship program is make sure that if you want to implement this trade, you know when earnings is coming up. So you don't do a covered call over the center of earnings where the expiration straddles the middle of earnings so that you lose out on the possibility of doing this trade. Okay, let's get back to AJ and other clients of mine that have had similar results and talk about how one of the things that we can correct with the Millionaire Mentorship Program is proper position management. So most options traders focus exclusively on entry points, which stock to buy, which strike price to select, which expiration date to choose. But the truth is how you manage your positions after entry is just as important as the entry itself. So this is where traders like AJ were making critical mistakes. He could have set up good trades and then panic when something moves against him so that he'd buy to close and create a loss. There's a lot of people that are doing that. They open up these contracts and then the stock moves a certain direction and they freak out. And so they're like, that's not what I wanted to happen. And they close it because they get scared and then they create a loss. Again, you guys, losses can't compound over time. It's really bad to make a loss because you take away money that could compound over time. So that's kind of just a mistake that they're making. Proper position management was always the missing piece that transformed his results from inconsistently to remarkably reliable. So let me show you the exact position management techniques that helped AJ generate his profits. The first thing is rollouts. Okay, rolling is a process of closing your current position on an option and then simultaneously opening up a new one with either a different strike price, expiration date, or both of those things combined. This allows you to extend profitable trades and manage challenging ones. Most traders simply let their options expire or they get assigned when they move in the money. And this is leaving money on the table sometimes. I use rollouts constantly and consistently. Like, if you ask me what I'm mostly doing in my options trading account, mostly I'm rolling. I'm just rolling stuff all the time. And it's I don't tend to sit there and like really put a whole lot of thought into the rolling. I know that that sounds crazy to you guys, but as long as I know that I'm rolling to a strike price on a covered call that's more than I paid for the stock, I just pick a date, roll out, roll out and collect more premium. And I don't care if my shares are being called from me. So rolling is just sort of like just this natural thing. Also, a lot of people get really like hung up on choosing the expiration dates and the strike prices and think that it's really going to make a big difference to their trades. And really what you need to know is that there's only two things that matter: that you can continue to roll if you choose to create more premium, and that you're always taking in income, and that you don't care that your shares are called. Those are the only two things that really matter as far as rollouts go. So if you're sitting there like obsessing for 10 minutes about a trade, like what should I roll to? Guess why you don't have the answer? You don't have the answer because you don't know what the stock's going to do. Guess who knows which way the stock is going to go? No one. So just choose something. Know that you can roll again later if that's the best strategy for later. Or you can have your shares called and whatever. Then that's cash back into your account. Congratulations. You get to make another trade, start a fresh position elsewhere. Okay, so with strategic rollouts, how do we implement these? If your covered call is approaching expiration and it's in the money, consider rolling out to a later date. You can roll to the same strike price or a higher one, depending on your outlook. But again, remember your outlook is only your outlook. You can't really determine which way the stock is going to go in advance. You're not psychic. If you were, you wouldn't even be watching this video, would you? Okay. But the goal here is to collect additional premium while maintaining your original stock purchase position and bringing down your cost basis on those shares and taking money into your account. And when you take money in your account, you can do things with that money. Okay. So this works especially well with quality stocks that you want to hold long term. And you should only be trading stocks that you want to hold long term. That is another prerequisite for me, is like I'm only trading stocks that I know that I would like to hold them for like 5 years, or I believe that that company looks really good for the next 5 to 15 years. And if I don't think that, that's greed. That's straight up greed, and greed will get you into trouble. So use rollouts whenever you want to extend a profitable position or adjust a position that is moving against you. The other thing that you can do is you can buy to close a contract early. So I only buy to close contracts early and when I've realized about 70 to 80 to 90% of the profit. 60% isn't really enough, neither is 50. So the idea here is that if you get paid $400 to sell a cash secure put and you've realized $380 of that profit, yeah, be sure to close that contract for $20, okay? I would even close it again if it was a $400 put that I sold and I wanted to close it $400, that'd be a 75% gain and I would take that. Why would I do that? Because I can get that collateral back in my account and potentially do the same thing again. That's a really important thing for the market that we are in currently because it's so volatile. And the volatility can really be your friend with realizing sort of 70 or 80% of these contracts and closing them out, because the opportunity of that opportunity coming up again is so much greater now than it was like a year ago. Okay, so to buy to close early, when you've captured 70 to 90% of the maximum potential of the profit on that position, consider closing it early. I like to use a stock alarm for this. So I kind of calculate to myself when I open the trade, what stock price would that stock have to reach for a ballpark idea for me to realize 70 to 90% of the value of that trade. If that's like a $10 move, then I'm going to set a stock alarm on my phone with the stock alarm app. It's in the app store. It's like a blue icon. It literally says stock alarm. It's free for up to like 5 stocks. Super cool. And I just put in like limit prices in there. And when the stock reaches that price, it'll ping me. And then I'll be able to make a decision and go check on my options, see if it's where I want it to be. And if it is, I close it out. That's how I don't spend a whole lot of time trading, guys, is I work with a stock alarm on my phone, and it gave me my life back. All right. So you want to calculate it, the remaining potential profit is worth the continued risk and tied up capital. So I just said that a little bit earlier, but the reason that you would want to close this position for 75% is because the stock could easily reverse just the next day with how volatile things are, and then you might only be able to close that out for something like a 10% gain. Well, we don't want to do that. That would be silly. So we'd be waiting for the stock to make a similar move to close it. But if you can close these contracts consistently out at like a 70 or 80% gain, you can like double or triple the amount of money you're making because you're just relying on volatility to do the work for you of making money for you. It's a beautiful thing. So I know this market seems scary to a lot of people. But there's so much more money to be made here as options traders off the volatility alone. So don't be scared of a market like this. I know it sucks that your overall portfolio is down on your longs. We're all going through that pain right now. That's very normal during a market pullback. But the worst thing you can do is get super scared that all the opportunity is gone, because actually, in a lot of ways, the opportunity has just increased like 2 or 3-fold. Okay. And we're just going to use volatility to make money from now on. So if you can close contracts, just know that you can redeploy that capital to make more money coming into your account. And that's always what we want. So the last thing that AJ was so great at was compounding his returns. So, once he got money in, he reinvested the premiums in other stocks, and he reinvested the premium that he made into more options to increase his future potential. And I was actually able to compound the returns of his education. Okay, so he proved to himself that he had success in one account. And he did that in a short period of time by following a playbook and following some rules and having discipline and being patient. Okay. And he had so much confidence that he went forward, convinced his business partner to let him manage some cash that they had in the business. And now he is trading company funds to create more revenue for that company. That is just such a huge win to me, and I'm so excited for him. Okay, so how you implement compounding returns is you decide which percentage of your options income that you're going to reinvest. Okay, you got to pay taxes. Keep that in mind. That's going to be somewhere between 20 to 30%, probably. Check with your accountant. But after you pay your taxes, you need to decide how much money you want to reinvest and what you want to reinvest in. Do you want to reinvest in new holdings of stock? Do you want to invest in new options? Okay. So you apply that to new strategies, or to make more positions, or to buy new long-term hold shares, and watch your income grow exponentially rather than linearly. Okay. So one of the things that I like to do with my options income in my 401k is that I will specifically only buy stocks that pay a dividend. And so what ends up happening is that, I'm buying these quality growth blue chip stocks, and they are increasing in value over time. They're monopolies, and they're also paying me a dividend. So I get a paycheck for stock ownership. And I really love that as a really conservative long-term strategy. Okay. So I'm using options income to buy my future freedom. And this is the core of my work optional system. The more premium I collect, the more money that gets redistributed and compounds, which means I have bigger position sizes over time. So let's talk again, just to wrap this up, about AJ's results. Before working with me, AJ didn't know what stocks he should trade to achieve his financial goals. He was kind of going after just like whatever stock that he was hearing that it sounded good, but he didn't have any real methodology for picking one. He didn't know when to enter positions and when not to, okay? He didn't know which strategies to use and when. He didn't know how to manage his positions properly once he was there. and had a position open, and he didn't know when to accept assignment and be graceful about it versus modifying that trade or taking a loss by closing out. But AJ's results are now different. After working with me, he learned the mindset and strategy behind achieving his financial goals with options trading. He learned exactly which stocks he should pick and when to enter them. He learned options trading variations that allowed him to maximize his trades and generate income no matter what the market conditions are. And he learned exactly how and when to manage his positions with confidence. I mean, again, that confidence really came through in him adding a second account that he wanted to trade. So this all resulted in AJ making about $100,000 in premiums, dividends, interest, and cap gains in just 96 days. And guys, like, I'm going to tell you, it only took him 6 weeks to learn this before the 96 days. He learned this all in like a 6-week course. He had the confidence to open a business account that made him another $10,000 for $37,000. So if we are like thinking like off that one account, he made 96K, almost 100K, and then he made another 10. It's not 106K. Like, I'm just so proud of him. And just, the one was in 3 months and this second account was in 1.5 months. He beat all the major indexes as a beginner trader, after previously underperforming them. So he cleaned up his act really quickly. Okay, the craziest part of all of this is that AJ has yet to graduate to the next stage inside of the mentorship program where he could trade the advanced strategies such as leaps, diagonal spreads, and credit spreads. So it's only going to get better for AJ as he moves along. Again, let's just focus in on AJ's results. Let's see his performance. It's great. He gained $41,000 in just this one account. And he's just doing fabulous. And I loved getting this email from him. This was completely unsolicited. I just woke up to this one day and was delighted to see it. So the best thing about AJ's results is that this is a repeatable system that doesn't take more than a couple of hours a week to learn. And it only takes a couple of hours a week to implement it for you to keep making these kinds of results that AJ was making. So if you want my one-on-one help with implementing these strategies in your portfolio, just like I did with AJ, then I invite you to book a call with me using the first link in the description to apply for the Millionaire Mentorship Program. Okay, the Millionaire Mentorship Program, we're going to go over this real quick. So in the program, you get my full stock selection system to identify the best companies for options trading. We go into greater detail there, and I share some real stunners of information. There's a step-by-step training on all 7 options trade strategies that I use to generate my consistent income. My proprietary position management techniques that I use to maximize profits and minimize risk. This is part of the spread system. I have some really unique things that I do there that are out of the box thinking that you won't get anywhere else. We have weekly group calls that help you implement these strategies, and you can get one-on-one guidance from me there in those weekly calls. You have access to my private community with successful options traders. You can find a trading buddy there. I know it's hard to find somebody that you could just talk options with. Find them with me. Come over and make a friend. I know that you want to talk options till you get blue in the face. So find somebody else who's like-minded to do that with. You also have ongoing support to answer all of your questions as you implement your system. I'm available. You can reach out to me. And then there are so many videos, like hundreds of videos of me trading that I've taken over the last couple of years of me being in a position that I had to modify. To just show you what it would be like when you're there, because eventually you're going to be in any of those positions. I have tried to cover off on every single possibility of any position I've ever been in, to give an example of what I did during that moment and what the best option was to move forward in that option. And so those videos are there to further continue your education. So you can apply to the Millionaire Mentorship Program by booking a call in the first link in the description below this video. And this program has helped over 100 traders just like you achieve consistent success with options trading. And I would love for you to be next. So I hope to see you inside.